According to a survey published by Aviva in the UK this year, men are almost twice as likely to invest in stocks and shares than their female counterparts. Almost 2 in 5 women surveyed say they don't invest at all, and almost 1 in 5 women think the risk is just too high. Yet women are also, anecdotally at least, pretty diligent in looking after their family's financial well-being, like hedging for risk with products such as insurance policies. So we're clearly not irresponsible with our money, nor are we not thinking about our futures. And joining me now to discuss this rather thorny notion of risk are Khadija Basir, Chief Operating Officer at 91, and Vivian Tabra, 91's Investment Director. It's Khadija, Vivian, it's great to be here with you this afternoon. Why do women seem so much more fearful of investing than men? Khadija, I'll start with you.
I think we're trying to strike the balance between avoiding gender stereotypes and really unpacking what seems to be very gendered behavior. And the stats that you shared made me think about a study that was once done around the sorts of jobs that women typically apply for versus the sorts of jobs that men apply for. It was found that on average, men apply for jobs where they only have 60% of the stated job requirements, whereas women typically apply for jobs where they have 100% of the qualifications. So there's a element of self-selection that actually happens when women are applying for jobs. And I think that this study was so revealing and compelling behaviorally around how women think and how women make decisions. And for me, the key point to land is, on average, I think women are a lot less comfortable dealing with incomplete information. If I think about family and friends, the men typically are willing to go a little bit by the seat of their pants, whereas women, I think, want to have full information. And so what we don't do ourselves any favors as an industry is often women feel that financial decision may be mired in a lot more, it's a lot more black box, and they don't have the full information to make those decisions. And that then results in people potentially preserving their savings in a bank account rather than making other decisions.
Yeah. You talk about the industry, and I suppose that's another issue that women investors grapple with, and that is what has traditionally been a male-dominated industry. And Vivian, I'm sure you've been in the market a while. You can probably attest to that.
I've been in the market a very long time. So over 30 years in the market, obviously there have been big changes. And that's not just in finance, it's across the broader spectrum of where you see women generally. So if we look at things like governments and congresses and national assemblies, you'll see that women are very well represented there now. Yeah. But if you look at the financial industry, if I go back 30 odd years, I'd walk into a room on the investment side and there'd be 15, 20 people and I'd be the only woman. Nowadays, that has improved, but we're still only around 30 to 40% of the overall numbers. And I think, yes, it is that black box environment that you're thinking about. Women are perfectly capable. They need to go into it, even if they have only got 60% of the information at hand, because they're perfectly capable of learning the other 40 very fast.
Yeah. I mean, and you talk about gender stereotyping, and I've got an anecdote that I'd like to share, which is my first experience with investing as a newly qualified job entrant. It was my first job in 2001, and I asked my father at the time, should I put 5,000 Rand into the stock market? And he said, nah, just stick it in a bank account, because bearing in mind it was the aftermath of the dot-com crash, the markets had collapsed, as you know. The sense of risk was running pretty high. So I thought, okay, fine, I'll do it. And the interest rates at that time were quite high, so the return wasn't bad. So I stuck it into a bank account, I forgot about it, I went overseas, and when I came back in 2004, I had basically missed a phenomenal stock market rally that began probably in 2002. And I remember returns of about 30 to 40% a year from 2002 to the end of 2004. So, and it takes me to my next question, which is, do we not actually understand what risk is? Because clearly that risk was in losing out on the returns that you would have had if you'd taken a little bit of upfront risk.
I think it's such an important concept to really understand, because common sense kind of dictates that risk is ups and downs in the market, right? Like, actually, if it's a roller coaster ride, you don't want to go there. But you need to think about risk defined in the context of what are your clear financial goals. So falling short of your financial goals is actually the riskier decision. And you can't you can't assess that in isolation. It's absolutely a multi-dimensional consideration. So when I say that, I mean you've got to think about risk in terms of, have I defined my goals? What are they? How are those goals defined in relation to time? So shorter term goals will dictate a very different course of action to medium term goals and longer term goals.
So if you're saving for a holiday, for example, you don't want to risk that money by putting it into a supposedly risky product.
Yes, exactly. And so it's the compounding effect means that you're also sitting on the sidelines. So you've taken the one end, which is a short-term, 1 year, 2 year financial goal, where the ups and downs of the market could potentially increase the chances that you don't meet that goal. But on the other side, you don't want to not participate in essentially what the market compensates you for taking on that longer term risk view. There's a rule of 72, but basically, when does your money, how long will it take for your money to double? And if you think about that in the context of 5%, for example, 5% takes you about 14 years for your money to double. Just a 2% additional growth brings that down by 4 years.
Sure.
So that relationship between time, risk, and return is an absolutely key kind of mechanism to understand so that you can make the most appropriate and, in fact, safest decision, rather than automatically assuming that putting your money under the mattress is what is going to protect your family.
Yeah. I mean, I think, Vivian, you want to talk to a chart which is quite illustrative of that conceptual notion of risk.
Yeah, and it's very important to get your head around that. So if you look at this graph, what you'll see is if you have 1,000 Rand and you invest it now over the next 15 years, or actually if you started 15 years ago and you had 1,000 Rand, what would it be worth today? So if you look at the bottom line there, the white line, what you'll see is that 1,000 Rand in terms of inflation, to be able to still have 1,000 Rands worth of spending power, that 1,000 Rand would have to become 2,100 Rand over 14 years, over 15 years.
And that's to buy the exact same stuff that you would have at the beginning.
Yes,
right?
Exactly the same basket of goods, the same shopping bag that you would have 15 years ago. If you take that money and you put it into that safe investment over the 15 years, you'll see that actually you'd now have 2,500 odd Rand. So you'd have done a little bit better than inflation, but not substantially better than inflation.
And Vivian, I see that graph is actually a fairly straight line graph. So you don't have the ups and downs that we were talking about in terms of risk.
Yes.
But it's very boring compared to the top two.
Yes, it is. It's really a steady return, but not a very exciting return. If you look at the top graph, what you'll see is that it's actually, at the end of it, you'll have almost 3 times as much as the inflation return. So it's given you very good long-term rewards, but over time, it has been very volatile, especially if you look at the dip there, the big dip where it touches the blue line. That was COVID. So we saw a phenomenal drop in market prices over a very short period of time, very volatile markets, and then it did bounce back quite strongly. Yep. So over the 15-year time horizon, you definitely want to be invested in riskier assets so that you can benefit from that return. But over shorter-term time horizons, you have to consider the volatility.
And that graph is so powerful because the piece that you are alluding to, if you had come in just before that crash and you were invested for the holiday, you were saving for the holiday, that would have been a poor outcome.
Yeah.
But equally, if you had started at the beginning, that is actually the best outcome.
And equally, if you had started at the beginning and sold out in 2020 and said, I'm not going back in because this is such a disastrous occurrence, you would have missed out on all the gains subsequent.
Yes. Absolutely.
What's also interesting about it, and it's not necessarily the most flattering to 91, is the difference in performance between the 91 Opportunity Fund and just the all share. And I think this brings us to a discussion of diversification, because I suppose in my mind I would think that the 91 Opportunity Fund is maybe somewhat more diversified than just an amount of money put into the JSE all share, which would be a basket of stocks, top 40 shares. Or you could argue that maybe the all-share chart represents more diversification, because diversification always comes up when we're talking about risk and when we're talking about investment. So, Khadija, perhaps you need to enumerate what exactly diversification means here.
So I think the graph was really instructive because the top line that speaks about equities, you can see the ups and downs, and as Viva said, the volatility of that experience. What you notice with the opportunity fund graph is that there is volatility, and you also get that amazing compounding effect over time, but it's a smoother experience. And this really speaks to what you touched on, which is diversification. And diversification is really understood as not putting, in very simple terms, not putting all your eggs in one basket. And so you want to make decisions that you are essentially enabling yourself to have something to cushion you from the blows of external shocks. What do I mean by that? Well, I think maybe an analogy is probably appropriate here that we can all understand. I think we are living in the age of social media. And if you think about the typical social media influencer, they would be what we call maybe platform agnostic. And that means that they can have a TikTok account, they'll have an Instagram account, they'll have multiple, I don't know all the other platforms that are available. But why do they do that? They do that because they are reaching different audiences, but also if something happens with a particular platform, it means that you don't lose your brand, and your brand is not completely concentrated in one place. Sure. And similarly, that's the way we think really about investments, is that you want to have some level of protection from the ups and the downs and the roller coaster, which gives you a flattened outcome.
I mean, the real life examples too, right?
Yes, there's plenty of real life examples. I think if also sort of turning to where we are at the moment and using an example from there. I mean, obviously South Africa's been the victim of load shedding, and globally there's a big push towards renewable energy. So a great investment would be a solar panel company, for example. But you wouldn't go and put all your investment into that solar panel company. Why not?
When Eskom surprises with 130 days of no load shedding.
And still going strong,
yeah.
Then you'd want it to be diversified. So you'd also want to have some of your tech companies. You'd want to buy your social media companies. You'd want to buy a retailer. Interest rates might be coming down soon. They might be doing better. You might want to buy some banks. So you really need to diversify it, and not really just across equities. Let's also look more broadly. There are times where bond markets and fixed income is going to do better. So really you want to get that blend. And if you do that over time, you'd get much smoother returns rather than that real up and down that we see.
So an investing example would be having a portfolio, and when we talk about portfolios, we mean a split of your money invested in stocks, bonds, cash, property, for example.
If you think about the fund availability, then the regulations ensure that there is a degree of diversification within the fund. So what you spoke about, for example, a balanced fund will have a certain percentage of equities that it's allowed to have so that you can get that dampening effect over time, right?
So you don't necessarily have to take the decision yourself.
No, you don't have to make that decision, but what you do need to think about is, what is my percentage of cash? What is my percentage of unit trust exposure, or whatever your chosen vehicle is? And that comes back down to our original conversation, which is being really, really clear around what are my financial goals, and then using your financial goals and the time horizon to really inform that product choice and product split, so that you have the benefit of diversification and a little bit of that safety and protection, so that you don't feel fully exposed to the vagaries of the market.
Yeah.
And as a woman, what you really want is you want to have the confidence to ask the right questions. And I think that's really the key when looking at what's happening in markets, what's happening in the global economy just generally, that you have the confidence to go and ask the right questions of your financial advisor so they can help you make the right decisions.
Yeah. And that is actually to not gender stereotype across the board. And there's no such thing as a stupid question. It's your money and it's your financial future that we're talking about.
Absolutely. And those questions are so empowering, because that enables both the financial advisor and you to really better make the best decisions for the right outcome.
Yeah. So if we had to sum up, say, 4 key themes that we've spoken about today, Vivian, the first 2 for you?
I think the most important thing really is to ask the right questions. Make sure that you're heading in the right direction.
Yeah.
For me, it's defining risk differently and not thinking that the safest decision is keeping your money under the mattress, but instead that risk is about defining your goals, and your risk is the possibility of not meeting those goals. I think another important piece is just to think about your risk and your goals in relation to different time horizons. And so we've spoken about something like a shorter term goal of saving for your holiday, a maybe medium term goal of children's education, or something where you need some more regular income stream. And then longer term, the most important decision is really about your retirement savings. And that is such a long term game where starting earlier will enable you to really have a high chance of meeting that goal ultimately.
Khadija, Vivian, we shall leave it there. Thank you very much for your time this afternoon. Vivian Tabor is Investment Director at 91 and Khadija Pasir is Chief Operating Officer.